Welcome to the It's Your Smarter Money Show, where you will learn well to live well. Discover investing and financial planning strategies, ways to live your best life, insights from engaging experts, and much more. Now, please welcome your hosts.
Hello, welcome. I'm Dr. Laura, and this is Professor Steve, and we want to discuss the fact that international diversification still has a role in everybody's portfolio. The case for diversification continues to remain very strong, both in terms of the benefits of diversification as well as just the theory continues to point to it, and long-run evidence continues to point to it. Um, Investors that want to stay just with the US should do that at their own peril, because we have a case that we want to actually interject. And it starts with the fact that if people don't have adequate diversification and have not really created an overall strategy, they will tend to react emotionally to what's happening in the market. So they'll react their overall attitude, their overall market behavior, and their overall investment in risky assets is all in, which is demonstrated on the right-hand side of this chart. But when things start going south and the market starts misbehaving, people go running to the other side of the pendulum here, and they oftentimes will end up selling assets at the wrong time, locking in those losses. And we've seen that over and over again, right, Steve? We've seen it
We have.
in
And
2001, 2007,
yep,
8, 9, even more recently in 2021, 22.
COVID 20, especially 20, also 2020.
Right.
Yeah. And the problem with that is once you get out of the market, now you have to make another decision when to get back in. And we've seen it too many times when people delay it. And, they start to sense that the market's improving and they get in, but it's already up 15% or
Right. And they've lost a
20%,
whole
and you've
lot.
lost that forever.
And so
Yeah,
there's
it's gone
that,
forever.
and we've seen this research done over and over again throughout the years, where generally they'll say the US stock market went up whatever percentage during that period of 20 years. And if you were out of the market for at least 10 of those days of that return, your portfolio was almost halved. And so number one, being out of the market, your portfolio is almost halved. But then if you sold at the bottom, it's even worse. You really damaged your portfolio.
One of the keys to this is if you think you have a near-term need for money, let's say within the next 2 or 3 years, keep it in something really liquid. In other words, have a smart place to get the funds when you need it. And that'll help reduce some of the stress you may experience associated with these big market declines, knowing, well, gee, I don't need that money right away. I can ride it out and let my portfolio recover. So that's an important consideration
Well,
here.
emergency funds, right, Steve? I mean, this isn't even part of the
Yeah.
conversation we were going to have, but I was recently reading something about how people without emergency funds tend to really divert their entire retirement plan, because emergencies happen. They always do. So having
They
adequate
always do.
emergency funds. Secondly, knowing where your cash is going to come from. And if you have enough asset classes in your portfolio that are diversified and are negatively correlated to each other, you should be able to find an asset class. Even in 2022, we had 4 asset classes that were up. We always had a place where you could go. So yeah, having a place, but then just being properly diversified, so you're not riding the roller coaster. Uh,
Right.
and
Yep.
especially if you don't have the stomach to ride the roller coaster. And we've seen a lot of scientific evidence and background to the fact that when people lose their money, they are they are much more unhappy than they are happy when they gain money. It's a
That's
very
true.
interesting thing, the way our brains work. But our job
Yep.
is to keep you from actually riding the roller coaster all the way down. And we do that through diversification.
Well, our job is to prepare you for the certainty of uncertainty.
There you go.
There's so many unknowns,
Yep.
and we want to prepare you for those, for those unknowns and things that can happen. And like we mentioned, it's good to have a smart place to get money when the worst happens too. And that
Mhm.
way it helps reduce stress in your life too.
So a lot of people think diversification is about bonds, right? Oh, yeah, I have fixed income, but it's much more than
Right.
that. We've talked about the fact that it's in the domestic market, not just investing in large cap, but other small cap, for example, and other types of asset classes, but it absolutely is also international. Uh,
Yes. Yes, and we've always had it as an asset class. I do know that there are probably a lot of other advisors that may have gradually moved away from it because of its performance, which we're going to talk about shortly. But in the long run, international does help improve what we call portfolio efficiency, and we're going to show that to you a little bit more graphically in a minute. But the way you measure portfolio efficiency is through a ratio called the Sharpe ratio, and it's pretty easy to understand. It's just a ratio of the return in relation to how volatile the asset is. That's it.
right. So
Okay.
standard deviation is that statistic that measures how erratic the returns are. Are they
Yep. Yeah.
closer to the average return or are they bouncing around a lot? And so that's how we measure volatility. And so Sharpe
Yes.
ratio takes that into account when it's looking at the overall return. And what we're showing here is that um, if you could go back, Steve, for a second, when he
Yeah. I'll go back.
said
Yeah.
with the Sharpe ratio, that the Sharpe ratio of the United States versus international is definitely better than international. But when you combine
Alone.
international and the world together, you get the best Sharpe ratio. So that's because these asset classes
Right.
don't move in tandem. They have different cycles of behavior. And the second slide that Steve was going to show shows the same data, but in picture format. So what we have on the
Yes.
x-axis is that volatility measurement, which we want to be further to the left. On the y-axis, we have return. Of course, we want to be higher on that. And so when we look at US, we say, oh, gee, US is kind of nice. It seems to have the highest return in that blue triangle in the
Right.
middle. And non-US a little bit low return, right? It's a lot lower, and it is so relative because you notice the
Yeah.
axis is kind of compressed. But
Yeah.
when you add them together, you would think that you would end up somewhere in between the US and non-US, right? Like wouldn't like just
Yep.
logically you would
You
think
would
that
think that.
the star should be somewhere between the triangle and the circle, and it's not. It's
Yes.
all the way pushed out, even less volatile than the triangle, um, and almost
Yes.
equal return. So if you could get an almost equal return with so much less risk, why wouldn't you do that? And this period of time is
Yeah.
from the 1970s to 2025. So this is a nice period of time that includes the most recent years, and it still points to diversification does give you a better return with less risk.
And I want to argue that some of this in terms of the United States' performance, may be an illusion, at least the difference between that and international, but we'll get to that. There's a reason for that.
Yes. This slide actually talks to home bias. It's a little bit old. So the first bar of the orange bar shows that the United States companies make up around 51% of all of the companies throughout the world. That's not true anymore. Over the past 5 years, especially, the US has mushroomed, and I think it's more like 60% now. But
Right.
still, the
Right.
relative comparison of what's going on here is still important to see because it hasn't changed. Basically, what this shows is that while the US has makes up 50% or 51% of the world in this context at this time frame, US
Yep.
investors put 80% of their investments in US only stocks. And the same thing if you go through and look at the Canadians and the British and so forth, while their countries only make up a small amount of the global companies, there's this thing called home bias where they tend to just stick with their own country. It's what they know, it's what they understand, but it's a mistake
Right.
because it's not really giving you the true diversification and the true exposure of what's happening across the world. And by the way, it's not enough to say US companies have US companies are multinational, so they have investments in the other countries. there's
Right,
further diversification for having the actual residency in those countries is still very important.
right. It is. And so, and we're going to show you one of the reasons why it's so important. From January of 2000 to January of 2010, international really outperformed domestic. Domestic was actually, this is the S&P, I think, it was down, actually down about 9% for that entire decade, while international was up almost 17%. So that's a big difference. That's what about a 27% swing almost in performance?
And
I
Steve, I
mean,
want
that's
to
a,
say something about this too, because
yeah,
one of the things that people say all the time, I hear this all the time, diversification doesn't work because when everything goes bad, like in the 2008, everything goes bad. And so
right,
therefore, it doesn't work. And while the truth is that I'm not, we're not going to argue that. Yes, everything does go bad. You can see that what happens before the episode and what happens after the episode matter. So even
right.
international actually went down even more than the US in 2008, but it still wound up beating the US considerably over the
That's right.
decades. So you can't just look at snapshots like that and say, oh,
No.
everything went down because it what happened before and after matter.
Well, you look, would you like to go through an entire decade, be invested in the S&P 500 and actually would have lost 10% of your money in 10 years? That would not be a good feeling. So if you had international as part of your allocation, your performance would have been different. So
Steve, I think that the people that were not invested with us during that decade that did a lot worse than down 10% during that decade because
I think you're right.
they were selling at the bottom, and
Yeah.
there was a lot of bad behavior during that decade.
Well, I've seen firsthand some people that after in 2008 they got out of the market in a 401k, put it in money market account, and never moved it back into any equity investments at all, and left it in basically in either a stable value fund or a bond fund for 10, 12 years. Completely missed out on the recovery after 2008, and what was a pretty good time for the market after 2008.
Right.
We only show 2 years here; it's truncated, but the market the domestic market did quite well. So that's the problem.
Mhm,
So you're right. A lot of people probably performed a lot worse than minus 10% for that decade. So,
mhm.
so this shows you the performance of the domestic, which is in blue, versus international, which is in orange. And so we could see it dramatically outperformed international. But we're going to show you a potential reason for that. And I'm not going to get into the details here, but it has to do with the disparity in valuations on the stocks of domestic versus international.
Well,
So we'll talk about that
driven by
further.
a lot of emotional things, by the way, um,
Yeah,
kind of like
yeah,
overconfidence and so forth. But
right,
so if you look at this chart, this is why when we talk to people, we have to kind of say, no, it's not crazy to invest in international because people are looking at what just happened recently. We call that
right.
recency bias. And they're
Yeah.
saying, therefore, that's what's going to happen going out in the future, which is not necessarily the case.
And so, international could have fooled people again. They gradually moved out of it, and guess what? The disparity, which we're going to show in a minute, of performance, we actually will show it now, and it's actually greater than this. The disparity in performance through of international versus domestic this year is around about 15%, roughly. So
Yeah, that's
these numbers
the
are
first
through.
year-to-date returns on the top. So the
Yeah,
EFA is an index that represents Europe and the Far East, and SPY is an index that represents the top 500 US stocks. And so if we
that's
just look
right.
at year-to-date, so you look at year-to-date, you can look at month-to-date, which is the next column. Um, but even if you look at the past 3 years, okay, SPY, the US, outperforms uh, over that 3 year period for sure. Uh, More recently, it's starting to turn around a little. And so you want to be
Yes.
careful with just trying to chase the top performing asset class of looking in a rear view mirror. You want to make sure that you're keeping in mind this shift.
Look, also, who could have predicted that international would have beaten domestic so much this year? We couldn't have. you know.
Well,
Uh,
Steve, I'm going to argue with you on that because we've been looking at the valuations in international and we've been saying, wow, I mean,
yeah,
international valuations, which we're going to talk about right now, they are undervalued by around, and I'm going to use that term again, three standard deviations below
that's
the
correct.
historical average valuation. Three standard
Yeah,
deviations is it's a tail risk for those people that understand what that means, or
enormous tail
almost like a
risk.
black swan. It's like really, really unusual. It's almost saying that, you know, out of maybe one out of 100 or even less, we would have that kind of view of the world. So we
Yeah, and
kind of
when I
need,
say we couldn't have predicted it, it's just that we figured it would probably happen at some point. We just didn't know
oh,
when.
we don't know
And guess
when.
what? We
Right,
didn't know it'd be this year,
right,
potentially.
right.
But it looks like it's starting to happen. We're going to talk about that further in a couple more slides here. And so this sort of backs up some of the graphs we showed you earlier. You can see, of course, international is in orange and domestic is in blue. And from 2002 to 2007, international dramatically outperformed domestic, but then that was reversed since 2008. And international didn't perform that well, about 5% a year, roughly, or I should say 5% total return. Uh, so but you're going to see something here. This rotation has happened a few times. So you can see from 1970 to 79, international outperformed. And it did again from 80 to 89. But then in 90 to 99 was domestic. Then from 2000 to 2009 was international. Then since then it's been domestic. So what does that make you think, right? It makes you think that maybe the time for international, it's the
Yeah.
time for it to
All
outperform.
cyclical. It's all kind of
Yep,
every uh, different asset class moves in a different direction, and it's hard to call when, but there are
right.
times where we can look at these different asset classes and say, gee, it looks like there might be time. It's not like we moved out of the US necessarily, although we've taken a very
Never.
quality, high value positioning in the US,
Right.
but we've never actually moved out.
No. And we've never moved out of international either because we know the history. We've seen this happen before, this rotation back to international. And so look, perhaps our client portfolios took a little bit of a hit for, a few years because we had some international. But guess what? Now you're getting paid for taking that hit. Potentially.
Well, our portfolios are not, so year to date, I was just looking at our portfolios this morning, Steve, and they're not
Hmm.
down. The
No.
I mean, they're not way up either because they have a variety of different things, but they're still in
Hmm.
positive territory, and that's
They are.
the name of the game is to not necessarily ride the roller coaster because we know people do bad things when they ride the roller coaster. This actually
Yep.
I pulled from some research that was done about 20 years ago, but it still kind of shows a point. It shows the correlate. So what we look at when we look at different asset classes, we're looking at not just the return and the standard deviation or the volatility. We're looking at how does this pair move together over time? And so we look at the US and international, and we see that they tend to be um, either negatively correlated or not fully correlated. So they're not moving in the same direction, just like what we saw happen in 2000 to 2010, 2010 to 2020. They had a different pattern, and that's what the correlation is measuring. Here we have
Right.
the US against France, Germany, and the UK. And really, probably the easiest thing for you to look at is over these sub periods, 72 to 1872, I should say, to 1889, and so forth, all these different like uh,
I remember that year. It was a good year, 1889.
sub periods, and how the correlations changed, where sometimes they were positive
Yeah.
and sometimes they were negative over time. And so from 1972, they started to be more positive. Um, although 0.475 is still not, it's still a good enough diverse relationship that we would want
It
to
is.
invest in it. What's
Right.
interesting about these different periods is there were periods where there was a lot greater economic and financial synergy between these countries, and when there are periods when they weren't. And the periods seem to coincide with that. And so the more
Right.
globalization occurs, the more correlated these different countries' performance are. Um, I'm not going to get into any kind of political conversation right now. I'll leave it up to yourself. And if you want to have a conversation with one of us offline, we're happy to have that conversation. But if you're
Yeah.
speculating that perhaps there might be a little bit less of a move towards globalization, maybe a more insular type of movement to all of these different countries in the near future, that might confirm a movement towards less correlation going forward. I'm just going to throw that out.
Possibly. Possibly. But we won't predict it. And by the way, and we're going to show something here. So domestic and international were pretty highly correlated since, well, this shows since 2022. But you can see here the correlation has dropped dramatically, beginning right around maybe March of 2024 or so. The correlation has dropped, which means international is dramatically improved diversification on our client portfolios. And part of that's because international's been performing better, especially this year, of course. And so obviously we like the fact it's not correlated because it enhances portfolio efficiency
Mhm.
and it reduces downside risk as well. And we see that because, as Laura mentioned, most of our client portfolios are not down this year, even though the S&P is down, I guess 5-6%, right, at one point. Most of our client portfolios are up, not a lot, but they're up slightly, which is a good thing. You know, it's always easier to have more money if your portfolio doesn't decline because it's hard to recover from declines. It's hard.
Yeah, I was trying to explain to somebody the math the other day, Steve, and
Mm,
again, we were talking about something that went up when they took $1 million, they invested in it, something very, very risky, and they had an 80% return. So they
right.
were very happy with a million eight,
One
and then
1.8
they
million.
lost 50%.
Now they're
And
down to
the whole
900,000.
argument, again, up 80, down 50, I'm still ahead. No, you lost 50% of that 1.8 million and you now have 900,000. So you actually lost 10% by taking on that extra risk. It's not worth it.
That's correct. And so what was your average return when you did that, right? You're up 80 and then down 50. So your average return was 30%, right? And if you divide it by two, if it's for a year, 2 years, it's 15% a year, yet you're still down.
Well, that's because the average return, what they call the
Yep,
arithmetic mean, is not the same as the geometric mean, which is the reality, which is the
the
real,
compounding.
which is a whole another conversation. But
It sure is.
volatility just really does damage, not just to your psyche and making you do emotional things that you should not do, but it also
Right.
really does do damage to your portfolio. And a lot of people don't realize it because they don't see they're just looking at average returns over year to year to year and not looking at it over time.
The compounding. Yep. And so this shows the actual performance of our international holdings in relation to the S&P 500 index. And this was, I think, through March 11th. And you can see here that our holdings are really outperforming the S&P this year. Hopefully it'll continue. I mean, I don't want the S&P to not perform well, but I'm just hoping that if the S&P does continue to perform in a volatile fashion like we've seen and perform poorly, that our international helps make up some of that ground. Uh, that in performance that you would expect on your portfolio. And you can see here it's broken down into we have a large cap international index we use, which is the symbol is IEFA. It's an ETF. We use the DFA institutional international small cap value. We're going to explain why we use that. And also we have the Pacer uh, developed markets, and they look for companies that have the highest cash flow in relation to enterprise value as well. So. And those are our three principal holdings in international.
With the value tilts, value and quality tilts.
That's correct. The only one isn't really is the IEFA is kind of a blend, but the
Right.
other two are value to it tilts. Yep. And so what's interesting is you look at the the top 10 holdings, what percent they represent in each of these indices. The top 10 stocks in the S&P are almost 37% of that index,
Here's
which
the
is
blue
really,
line. So the blue line represents the US domestic large cap stocks.
yep, yep. And it's principally those seven, the Mag 7, the media likes to call them, and three other stocks, but it's almost 37% of the S&P, which shows that it's not a diversified index at this point. And that I think reflects some of the volatility we're starting to see in it because some of these companies, for example, Tesla and Nvidia have been hit pretty hard in some ways. But you also see the greater diversification of, for example, the international small cap, which is in light blue on the bottom, the Pacer cash flow based international ETF, and also the IEFA index. And you see the difference. I would say that the Pacer is most concentrated because they only invest in the top 100 companies for free cash flow. So maybe, I don't know, like 11, 12%. Actually, maybe 20%, I should say, is in the top 10 companies, top 10 holdings there. But this concentration for the S&P 500 is scary, in my opinion. So the other thing that's interesting is a lot of the return in an academic study I read of the difference in return of the S&P versus international over the last 20 or 30 years has been because the difference in the way the stocks are valued. And one of the principal ways you value stock is through something called price to earnings ratio. And so that's the price of the stock on the market in relation to their earnings. And so you can see the S&P is around $27 roughly for each dollar of earnings. That's really expensive. And so you can see the difference with the EAFA index, MSCI EAFE index, which is 15 or 16, the International Small Cap Value, which is about 10, and for the Pacer, which is about 10 as well. And so the average differential in return over the last 20 or 30 years in international versus domestic is about 4% a year. If you take away this expansion in the valuation of the stocks, it'd be close to about 1% a year. So the issue there is, can the valuations for domestic stocks continue to increase? Odds are very low. And like Laura mentioned, I bet you it's a what, a three sigma or three standard deviation event probably. So the odds are very low. So this is a good indicator that international could continue to perform well in relation to domestic in the next few years.
And Steve, I don't want to complicate things, but I do want to say regarding the S&P 500, the top yellow line,
Mm,
we showed you the slide before this that showed that it was this particular index is heavily concentrated in the 10 top stocks. And those
yeah.
top stocks happen to be highly valued. In other words, their valuations
Yep.
are way in excess of what the normal expectation of a price would be in a particular stock. And so that's driving it. When we look at, so for example, if you look at the equally weighted index for the top
Good
500
point.
companies, that is not negative. It's actually positive. Oh,
Yes.
it might be
Yep.
flat but it's definitely not that bad because it's more broadly diversified across all the top 500 companies, as opposed to this index that's very heavily weighted towards those top. So it's those top companies really that everybody has seemed to love, that we've kind of stayed away from more recently, or, not that we're not invested in them, but we're invested in them at a much smaller amount uh, because of their valuations and our concerns with them being a little too far over their skis, if you will.
Yeah, our domestic large cap holdings are much more diversified than the S&P 500. Yeah, and we have a much lower percentages in the Mag 7 and these 10 stocks that are so crazily overweighted in the S&P 500. So let's talk about why do we think internationals perform better? Well, there's a couple of reasons potentially, valuations we mentioned, but also some of it's a currency effect. And so the dollar has weakened in respect to the euro. So that's one currency we're showing here. Um, and so you can see the difference right now. It takes $1.08 to buy a euro, which is a weakening of the dollar. So that does help domestic investors in international stocks. Okay. So that has provided some wind from the rear, but there are some headwinds that we always want to be cautious about with international. Well, we don't know, we can't predict the future, but one thing that's interesting is that about 25 years ago, the US's GDP was about the same as the Eurozone, which is now, but now the US's GDP is about double the Eurozone, which is really interesting. So the US has grown much more quickly than the Eurozone has over the last 25 years. And so you can see even here of late, the GDP growth in the United States has been higher than Europe and a lot of so I have let's see, I have Germany and the Eurozone here and the UK. So it's been much higher. So that also leads us to believe that the strong possibility that that could change and it could be some rotation back to these countries. But
Well, a
this is
lot
what's
of that is
happened.
the whole AI play. It's all the technology in the AI play.
Hmm.
And I do want to say that the economists that I listen to, all of them are still forecasting a global growth in GDP across all the countries. They believe
Hmm.
that the US is going to be a contributor to that growth, by the way. So for those people that are
Yep.
concerned about a recession, which I'm not saying couldn't happen. The economists are still looking at the fundamental hard numbers, and they're saying it looks like we still have growth in all these
Yeah.
countries. So that's
Yes.
exciting.
Yes. And so another potential headwind, not for international investments necessarily in general, but for a couple of the countries within these indices, are the cost of energy. The United States is still, energy is pretty inexpensive in the United States, roughly 18 cents a kilowatt hour for electricity, versus I'm going to really focus on the UK and Germany. The UK, or Belgium's high as well, but the UK is about double, and Germany's over double the cost for energy, and energy is such a critical component for every aspect of production and industrial processes, and it's also a lot of the products that are come from petroleum are also huge are inputs into a lot of they're precursors to a lot of materials that are produced. For example, plastics, fertilizer, other things. But having low energy costs is really important. So this has actually affected Germany. Their energy costs are so high that Germany effectively is gradually becoming deindustrialized. But I'm not overly concerned about our international investments because we are diversified by country. So despite perhaps Germany not being the industrial power it once was and maybe having a GDP that doesn't grow as quickly, we have other holdings within our international investments. So
And the
Europe and
countries
we have,
rotate constantly. I mean, if you look
yep,
at I was looking at the top country that performed last year. It was Singapore, of all things.
there
There's
you go.
it's always moving, and that's why we do have in our selections, we do have some of the Far East, not all of the Far East, but some of like Japan
Yes.
and Singapore and some of the more developed countries are in our indexes.
So now I want to mention something that we've talked about I think before, but we'll bring it up again. Is a lot of advisors believe in using emerging markets funds, and they use them principally because the belief is they improve portfolio efficiency by having a lower correlation with domestic investments as compared to large international companies. But we've never really cared for emerging markets for a couple of reasons. But let's first talk about what we use instead of it to improve portfolio efficiency, and that's international small cap value. And you can see here the correlation of international small cap value versus domestic, and also emerging markets versus domestic. And there is somewhat of a difference. Emerging markets are somewhat less correlated, but international small cap value does provide probably enough of that lack of that correlation to help improve portfolio efficiency. But what's really important to look at is the disparity in the performance of international small cap value versus emerging markets. And this goes back to around 1993. And you can see the difference in an international small cap value, which we use, you would have earned about 1,060% in terms of growth, total growth, whereas in emerging markets, about 476%. So that's a big difference. So in our mind, it's well worth taking that hit in terms of difference in correlation of about zero point 0.1, 100 basis points in terms of correlation to get this additional performance that we've gotten from international small cap value. But there's another issue. International emerging markets tend to have a high percent of their holdings in China. And it's hard to tell from this chart, but if you look at the black bar there, that represents the exposure of the average emerging markets fund to China. It's about maybe 25 to 27%. And I'm really deeply concerned about the political risk associated with China. Look, I just saw yesterday, which was kind of shocking, that China has these barges and these other bridges that they actually could use if they wanted to invade Taiwan, go across that channel and actually invade them from the beaches. Now, I'm not saying they're going to do that, but it is a major concern, and China is a major competitor of the United States on a military standpoint right now. Their Navy has about 370 ships. We have about 285 or 290. So the question is, why is China building up a Navy so quickly unless they intend to use it? And I'm really concerned about that. And if they do decide to invade Taiwan, I think you're going to see a big problem with a lot of investments that have been made in China. They could nationalize them. Who knows what could happen? So we don't like emerging markets. And there's other countries here
They
too,
also
which
don't disclose the just lack of disclosure. It's not just the political risk.
great point, Laura.
It's we really don't know what some of these companies are doing, and some of them are nationalized. It's just really, really hard to look at a company. We don't have the financial statements that
No.
we have in the United States or anything to really determine if anything is overvalued or correctly valued or that type of thing.
And look, I don't want to get political either, but I'm still concerned with a country that actually employs slave labor with the Uyghurs in China. That's really a big concern. And a country that's willing to do that, I think, is a huge political risk going forward. So, ultimately, I don't think there's a lot of value in using emerging markets versus what we use, which is international small cap value. Now, just to put this into context, our large cap holdings have almost nothing in China, and that's through the IEFA ETF, which is based on the MSCI EAFE index. And our international small cap value pretty much has nothing in China as well. And our international small cap value sticks to developed countries, countries with stable political systems, and the countries that are less likely to nationalize industries and really hurt investors. And you also have a stronger view toward contracts.
Thanks for listening to the It's Your Smarter Money Show. If you found this episode valuable, please like and subscribe to our channel. Until next time, learn well, live well, since, after all, it's your smarter money. Thanks for tuning in, and we'll catch you in the next episode.